Good afternoon and welcome back to the virtual VETS'20. Today is the halfway point of our 16-part webinar series hosted by the National Veteran Small Business Coalition. I'm Earl Morgan, NVSBC Program Director, and to our new attendees, thank you for joining us today. On behalf of the Board of Directors, I would like to take this time to welcome our newest members of the NVSBC. I know many of you are attending today's webinar, so we'd like to thank you for joining the coalition. We hope to meet you all in person in 2021. Again, thank you to our 8 sponsors who made this webinar series possible. Runtime for the webinar is 1 hour. If we need to go over, we will. During this webinar, if you have any questions, please type them in the text box on the screen. We try to get to all the questions on this webinar, and if by chance we missed your question or don't have time to answer it, we'll get the answers to you and post it on the virtual VETS'20 replay webpage. And now I'd like to introduce our Executive Director, Mr. Scott Jensen.
Thank you, Earl, and welcome everyone. Good morning and good afternoon, depending on where you're calling in from across the country. It's great to see you all again this week and be here with you. I too would like to echo Earl's comments and welcome the newest members to the NVSBC. It's great to have you on board, and we look forward to working with you now and into the future. Today, we have a really special opportunity to discuss what it means to plan and what it means to plan for the future. And we have 2 very special guests that have spent a lot of time and have worked with us in the past, and we're so happy that they're back with us today. And so I'd like to introduce first Sarah Jamshidi. She's the president of Speed Shift Ventures. She's an exit strategy advisor and licensed investment banker. Sarah helps business owners make their exit strong, certain, and something to celebrate. With almost 2 decades of helping investment banker, Sarah helps business owners in various ways. With almost 2 decades of helping more than 200 companies with startup, growth, turnaround, exit, and succession plans, her innovative and holistic approach opens up opportunities and changes perspectives to your advantage as a business owner. Analyzing financial, business, and personal goals, she helps determine the best exit options and grow and structure your business into the best position. She's dynamic in leading implementation, as she is in strategy, steering fiscal operations, and mergers and acquisition processes for board members and executives. But first and foremost, Sarah focuses on business owners, guided by her conviction that your most successful exit starts now. Sarah's worked in multiple verticals. She's worked in global teams. She's raised more than $25 million in venture capital for portfolio companies. As I mentioned, she's currently the president and managing partner of Speed Shift Ventures, and she's also the managing director at National Capital Companies Investment Bank, and she's based in the Washington, D.C. metro area. Joining her is a partner at Speed Shift, Jeff Salinger. Jeff's an accomplished senior executive drawing on more than 40 years of experience in finance, marketing, technology, operations, and strategic acquisitions and alliances. Over his career, his responsibilities have been vast, including manufacturing, distribution, marketing and sales, customer service, and everything in between. As a CEO and a COO, he's had direct responsibility for hundreds of employees and multi-million-dollar annual operating budgets, has served as a board director for numerous firms, and assisted many business startups. Jeff's managed a venture capital fund focusing on green, environmentally progressive investments. He's helped build a government-sponsored enterprise into an industry-leading Fortune 100 firm, and he owns and directs several small companies in manufacturing and real estate. We are thrilled to have you today, Sarah and Jeff, and thank you so much for giving us your time. I'll turn it over to you, and we just look forward to talking with you today. Thanks again for being here.
Thank you. Thank you, everyone. Jeff and I are excited to be speaking with you on this topic that's near and dear to our heart. Thank you for hosting us. We love, the VETS conferences. We've attended many years. So wanted to shout out to the friends who may be in the audience and clients. So again, thank you, and thank you, Earl and Scott, for having us. So without further ado, we can jump on a topic. And as you saw, we're going to talk about M&A and talk about to what extent you can use that in your toolbox as a strategy to advance. Before we talk about our company for a second, wanted to share a story, and that's going to be a theme for our conversation today. And that is back in the 1980s. We all know actually today, Mantech, of course, has a market cap of over $3 billion. But back in the 1980s, George Peterson, who is the CEO of the company, wanted to get into the intelligence market. And at the time, Mantech was primarily a Navy contractor. And as we all know, in order to get into the intelligence community, obviously you need to have the contracts. But in order to have the contracts, you do need to have the clearances. But you need the clearance. You can only get the clearances if you have the contract. And so that chicken and egg story has been there for a long time. So one of the mechanisms that George Peterson actually got into that market at the time was by acquiring a piece of business out of Raytheon, a 57%, a surveillance operation out of Raytheon that gave him an opening into the intelligence market. And so now we know, of course, Mantech is a great big company with great market share. But basically talking about using opportunities in order to advance is a topic of the discussion today. So a little bit about us, Speed Shift Advisors. We are a lower middle market advisory firm, and we have one mission in mind, and that is working with business owners and rolling up our sleeves and work alongside of our clients on strategic and growth planning and figuring out exit options and helping business owners execute those, and business valuations along the way for various purposes, and obviously merger and acquisition, which is the topic of our conversation today. Next, please. So as we talked about, Speed Shift Advisors, we have 4 pillars of services, and today we're going to talk about how you can use M&A to your advantage to grow rapidly. Next, please. Okay, thank you. So obviously, we picked the topic before the pandemic, but Jeff and I have looked at the market and have kept an eye on what is happening, and we continue to think that M&A can still be part of a growth strategy out of this pandemic situation. And so we're going to talk to you about how you can retool potentially your companies and use M&A, acquisition as a mechanism to advance quickly and use it as a recovery mechanism as well. Next, please. So, but first, let's take a look at what is happening in the marketplace in terms of M&A. Let's see what that tells us. Next, please. Sorry.
Oh, computer froze. Give me a second here.
All right, well, I can talk while you do that.
There we go.
What? Okay, well, there you go. All right, so if we take a look at 2019, we had about $93.8 billion in terms of aerospace, global aerospace defense and M&A activity. Next, please. Hopefully it didn't freeze this time again. So what we saw before COVID lockdown, M&A activity was at all-time high. Valuations were high, and there was, positive economic outlook. When the lockdown started in March, we saw the M&A activity decline a bit, actually considerably across multiple sectors, and obviously in the defense and aerospace and government sectors as well. Now, while the defense and government contracting has been doing a little better than, other sort of subsectors of the economy, there were a number of things that were coming into play. We saw the debt markets frozen a bit, and then the uncertainty affected the M&A market. And so what we saw was the deals that were in the later stages of maybe due diligence, what have you, they went to a close, but some of the new transactions that were going to come online were put on the back burner to see what is going to happen. But what we have seen is that we've seen the June numbers come back up again, And we've seen the capital markets open up a little bit. So there's a little bit sign of things opening up, and particularly in the GovCon sector. Now, there are some sectors like the aerospace that still have face some challenges, but we have seen some slight recovery, and we've seen a good sort of activity that's going on. Next, please. So let's take a look in terms of numbers. And so GovCon M&A activity, we saw at the beginning of 2020, January, you see a high number, and that's basically the transactions that were in the works in the later stages, and they basically went through. And now we saw a decline, as we talked about, and then in June we saw a number. Well, overall, when you take a look at it in the aerospace and defense and government contracting transactions, pre and post, or during, I should say, because we're still not fully out of it, the numbers are shaking out to be not too bad and close. And once you start putting that against the backdrop of other sectors, it's still pretty strong. Next, please. So where is the activity happening in the sector? A lot of it, as you can see, 62% of them, it's in the sub 100 million in terms of a transaction size. There's still consolidation going at the top, as you can see, 13%, 5%, what have you. Those are large transactions, so there's still consolidation that's happening. But essentially, a predominance of the transactions are sub 100 million. Next, please. So we think that this is a crucial time. We say winners and losers are forced in the crucible of turbulence. I mean, losers is a strong word here. But essentially what we're saying is that this actually may be a great opportunity to take a look around in the marketplace and figure out what opportunities may be there to be able to help advance your growth out of this sort of downturn. And so this is the time where we think there's a couple of things to look for, and we're going to talk to you about them in this presentation. Next, please. And so we have also history showing that. So it's not just basically, this is not the first time. Yes, it is the first time where we have a pandemic. It's affecting us to this degree or in recent history, but we can go back and take a look at the financial crisis. And if you take a look at financial crisis in this diagram, as you could see, the bottom line indicates the companies that basically were trying to adjust. They weren't prepared for a downturn. They didn't anticipate it. And then basically acknowledged the downturn a little late. They had a wait and see kind of mode attitude. And then they sort of struggled to bounce back a little bit or had a slower recovery. When you juxtapose that, and this is basically looking at a large number of transactions over time, when you take a look at the companies that actually anticipated the downturn, now nobody anticipated the pandemic, obviously, but now that we are in it, looking at it as a mechanism for where the opportunity pockets may be and taking advantage of those opportunities can help accelerate the growth. When we take a look at the financial crisis and the companies who did that, we see that they basically grew, they had an accelerated growth, significant. As you can see, there's a big delta between the two sets of companies. Please, next, please. So we're talking about, again, a little look at history. Now, looking back at the great financial crisis of the 2008, this is looking at approximately 10,000 transactions, going through and looking back before the crisis and then during and after. And we see that the deals that actually happened during that downturn actually ended up doing better. So the weak economy deals actually statistically outperformed the strong economy deals by about a factor of 9.6 times. So we can talk about what's really behind that in a second. Next, please. So you may think, yeah, thank you. You may think, well, obviously companies are valued at a lower valuation, and so that makes sense. So then you get a bigger return. That's one of the reasons. Yes, you can find opportunities and you find price adjustment because of what is happening in the marketplace, but that's not simply the only factor. There are a number of reasons that the companies took advantage of that time, actually did better over time. And so, yes, valuation is one factor, but one of the other areas is that the companies that had put a strategic plan in place and had a strategic acquisition agenda, and they positioned themselves for it very well. When the downturn occurred, they looked for opportunities And when the downturn was over, they did better than industry average in terms of performance, and they recovered. And while other companies were trying to, coming out of the downturn, they were trying to piece themselves back together to survive. These companies that did acquisitions during the downturn focused that time to sort of put synergies in place and you really optimize the integration, what have you. So when the downturn was over, they basically accelerated rapidly. Next, please. What we have seen this also with our clients as well. And now we've worked with companies of all sizes. We have helped companies with 4 or 5 million in terms of revenues look at particular contract vehicles and try to acquire those contract vehicles because they were strategic. And we have also helped companies identify and go after and purchase companies as well. And so what we have seen with our clients over time is that companies that look at organic growth, and so fine-tuning their BD engine, their sales organization and capture, in addition to looking at opportunities for inorganic growth, acquiring, whether it's contract talent, whether it's customer, and bringing those together and maximizing the synergy, they have done very well over time. Next, please. So again, we're, forgive us, we're kind of statistics oriented. And so we like to look and see what the data tells us and what the trend tells us. When you take a look at, historically, companies that did acquisitions, so in organic growth versus companies that just simply relied on organic growth, that's the zero on the left-hand side. The companies that didn't do any acquisition, once the things returned to normal, they grew okay, and they had a great growth. But the companies that did multiple acquisitions, they grew more rapidly and they had more return to their shareholders. Next, please. Did it freeze, Earl? There we go. Okay. So the other thing that is actually interesting is, again, nobody saw the pandemic happening, but we also looked at historically to see what companies did well, and we looked at it from multiple angles as we shared. But one of the key things that was very interesting is that the companies that put some plans in place, had a strategic plan, had a strategic objective, basically they were ready, and when the market condition turned the way it did, they looked for opportunities and they were ready when a good opportunity arose, and they could actually take advantage of it. And so that's really on the left ring, when you look on the screen, the green, the 46%, those were the companies that had positioned themselves well, and when the right opportunity came about, they could actually execute. Now, the right positioning yourself well, there's a lot of things that goes into that. We're going to talk about some of them today. In terms of what things you can put inside of the company, your company, to be ready for that. Obviously, a good component of that is going to be financing as well. And that's a whole topic that we can get into later and another topic. But there's a multiple factors. So getting the company ready to take advantage of opportunities was hugely successful. The other one is basically making a strategic plan and focusing on what opportunities they want to go after and actively go after it. And that is the purple. Hopefully the colors come across your screen well as well. That's the 33% on the left circle that you see. So again, a lot of companies did well with that. And then also knowing what the end game for your own company is, whether it's 20 years from now, whether it's 10 years from now, and then working that into the plan as well has helped to figure out where you are and what you need to acquire to basically get you there. Next, please. So, I think you can agree that there are a number of benefits to looking at inorganic growth in addition to organic growth to help accelerate your businesses forward. One of the benefits of inorganic growth obviously is a long-term reputation that you could develop. It also helps you and helps your company hedge against any customer losses. And so by by having a diversity in the customer base that helps you in terms of valuation of your business, and it strengthens your business as well. It can enhance the value proposition for your business as well by acquiring additional value propositions, if you will. You can gain a competitive advantage over the competition as well, based on the capabilities, based on the talent, based on a number of factors that you acquire. It also helps provide a positive outlook on the growth for your business. Then it will be new opportunities that you can pursue with the new capabilities that you've acquired. Also, financial strength could be a component of that as well, depending on the acquisition. And let's not forget the most important part, and that is the human capital aspect of it. And we know in the government contracting, that's absolutely crucial. And so if the acquisition is done right and you have acquired great talent, that is going to pay dividends over time. Next, please. So growth, it's, we all know the hockey stick curve that everybody would like to have, but really in actuality, if you zoom in, growth actually happens in spurts. And really it has a staircase shape. And so it comes in bands. But what we have seen in working with our clients is that, growth requires the right market condition. Now, we don't mean always great market condition. It could be good or bad market conditions, but then it's just your perspective and taking advantage of that. But so it requires a market condition, an innovative approach, and also some funding. And again, we said we're not going to touch the funding for the M&A. That could be a topic that we can get into at later presentations. But those are all the components. As you could see, you can grow from bands from small to lower middle market and keep going up. Next, please. So, looking at the reasons why some of our clients and other companies similar to yours have looked at M&A and what it actually did for them. And so if you take a look at this chart, what we have is based on size for companies that are between 10 to 50 million or from 50 to 100 million and above, how M&A has helped them. The number one reason has been helping them with growth. That's almost adding another engine to your already BD engine. And so really accelerating the growth has been fantastic. So that's the number one. As you could see, 72% of companies between 10 and 50 million, they said it helped them with growth. The second thing is with increased competitive pressure, whether it's pricing, whether it's profit margin, whether it's what have you, and consolidation that's happening in the marketplace, it has helped them remain competitive in the marketplace. The other one that is important also is that acquiring any intellectual property or technology that may be able to give them another advantage to go after their existing customer base. So acquiring the business with that, but then taking that core also and now applying it to their existing customers. That has been helpful as well. And it also helped them sort of gain a little bit of a mass also in the marketplace as well. Next, please. So you may sit back and say, well, Sarah, these are all great things, but where do I start? And Jeff is going to talk to you about that in terms of how to look at this and how you can actually execute on that. So I'm going to touch on a very high level how to approach it, and Jeff is going to bring it down further into actionable pieces. But the best place to start is basically create a blueprint for success. And how do we do that? Is basically sit back. When you sit back and you say, okay, what do I have in my company? What are some of the key strengths? What are some of the key things that I have in my company? And then the other thing, which is somewhat maybe counterintuitive, is play it all the way to the end and figure out what is ultimately the exit for your company. Now, you could be sitting here and saying, Sarah, I'm not thinking about that for another 20 years. That's fine. But thinking about what the possibility for that is and how you like that to happen, then reverse engineer that back to today. That's basically we're going to use that sort of approach. And so now you can figure out what you have, and then you can figure out, all right, what's my timeline for that? And therefore, what are some of the things that I'm missing? That can give you a lens to now look into the marketplace and figure out where the pockets of opportunity may be, which we think there are around you. So that gives you a plan, a roadmap to figure out, all right, I got to build organically, continue to do that. And then the other thing is, all right, maybe I want to open up and think about some inorganic growth. And that is look at opportunities, whether it's a contract vehicle, whether it's a customer, or whether it's talent that I want to acquire outside of a company or a whole company. And then the other option is, maybe the time is right for me to exit now. But all in all, that provides you a lens to look through. Next, please. So as a buyer, what are some of the areas to look at? Next, please. So basically, just the way you look at your company, looking at the targets in the marketplace the same way. The place to start, obviously, is looking at the earnings and see how that company has been doing. Growth, one thing is, we know companies obviously are valued based on historical performance, but they're actually acquired for the future. And so figuring out what the future story of whether it's the contracts, customers, and the company is that you're looking to acquire is going to be an important factor. The other is, what is your risk profile and how much you're willing to risk? And the other one is capabilities. What capabilities are you looking to add to your already existing set of capabilities? Next, please. So we've talked about this in other previous presentations, and how you can look at your company in terms of valuation and figuring out what the dials are. The same applies when you're looking at your target. Obviously, looking and figuring out how they've grown over time, that's been great. What has been their growth? So that tells you about the health of their BD engine and how well it's working. We all know that not all revenue is the same and not all contracts are the same, and they don't have the same profit margin on them. And so figuring out what the profit margin on them are, that's important, also an important component factor. And you can see the multiples are on top, and basically the length of the arrow is going to tell you the importance of it. So if you look at the EBITDA margin, if you have 5% or you have 15%, they have different valuations. 15 is at the higher end of the valuation, and 5 and below is on the lower end. Looking at the customer mix is also important, and also how well they're connected to their customer is important. We had a client that simply got acquired because they had a very strong, as we call, connective tissue to their federal customer. And they had been serving them for a very long time, and they got acquired because of the nature of the relationship they had and the strength of the relationship. Looking at contract mixes is also important. We all know the prime contracts are valued much higher, full and open as well. And you all know this, I'm pretty sure, but the thing that probably may be new is what valuation multiply applies to those factors. And intellectual property and anything that's going to give you a competitive advantage also is going to be important as well. Next, please. So just real quick, we talked about valuation multiples. The bottom third, where you can see a 3 to 4 time forward EBITDA multiple, typically smaller sizes, probably lower skill sets in terms of delivery of the, in terms of contract. And then, the maybe BMP capability is not all that great, but it also depends on the type of work being done. And then the middle, where you see 4 to 7, which is sort of a good multiple, you see typically comes with larger, companies, 15 to 40 million. And then it's because of the, the customer diversity, the contract mix, multiple capabilities they may have had. And that's where it comes from. And of course, the top, it depends on the nature of the work, whether it's machine learning, or whether it's, cyber, what have you, that, commands a different kind of labor force, as well as a different kind of profitability on those contracts. They may also have IP along the way for those reasons. And so those are the multiples that we see. Next, please. Okay. And just the last thing before I hand it over to Jeff, as we talked about, there are multiple factors that affected. Looking at the business fundamentals of the opportunity you're looking at, if you're looking at the entirety of a target company and not just the contract vehicle or the talent that they have. So business fundamentals, looking at the backlog and the pipeline, the contract win rates, and those things, and the set aside, if they are another STVOSP or woman-owned, what have you, and what is on what kind of contract vehicles there are. And then the financial performance, looking at the revenue and EBITDA trends and figuring out how they have been, as well as the margins. They are very critical and important. And then operational issues, that comes in when those are important and you may not look at right away, but when it comes to the integration, they become absolutely crucial, how smooth the integration may go. And so looking at the management depth, looking at business system, what accounting system may be using, those things are going to come in handy when times come for integration. Now I'm going to hand it over. Next, please. I'm going to hand it over to Jeff to sort of take us further into how we're going to execute on all this.
Thanks, Sarah. Good afternoon and good morning to all the attendees. And I also want to thank you very much for your service to the country. It's greatly appreciated. And now let's talk a little bit about the strategic plan. You've seen from Sarah the trends and transaction activity under different economic circumstances. You've seen the impact that inorganic growth can have. And so now let's turn to some of the considerations and how this fits into your strategic plan. Next, please. So let's start first with organic growth planning strategy. It is important to define your niche, know your firm's particular strengths, and build on them. If you make your customer part of your sales force by doing things that improve their standing, that will help you long-term and short-term. It's important to know where your value is and how you're going to grow it. For instance, moving from set-asides to full and open, moving from sub to prime, all are important considerations in growth. Investing in your business now, that is very important. You can start by adding personnel bench strength, perhaps, if that is needed, or even doing some things with the physical infrastructure to allow for growth in the future. Make having a strategy and measuring progress against it just a part of your company's DNA. Very crucial, important to sort of always be looking at it, measuring it, evaluating it. Think about employee retention in the human capital area, cross-training, having key backups. All those things are important to sort of getting your company ready for doing acquisitions well. And very importantly, align your business strategy and operations with your own personal goals. That is always key and something that Sarah and I emphasize to all businesses that we talk with. Next, please. As you think about marketing strategy, you have options. You can build vertically or you could build horizontally. For most businesses, this means starting with the inch wide, mile deep approach. And that allows you to build vertical expertise and credibility with your customers. And once you have dominated that niche, then you think about horizontal expansion. Next, please. Think about this aspect of marketing as going after the lowest hanging fruit first. It seems pretty obvious, but this enables you to sort of build customer trust as you'll be given more challenging and more importantly, higher margin future work. And this this is really the inch wide, mile deep approach. And again, what we call vertical penetration. Next, please. To figure out sort of how to start, how to get on the road, you want to evaluate some of the competitive strengths and weaknesses, as well as your opportunities and threats. Important to keep an eye on them as well. So you want to be expansive in your thinking. You want to be looking at prime or sub partners or joint venture possibilities. Next, please. Now let's talk about inorganic growth by considering some key questions to ask. Next, please. So does the target business have anything that is particularly attractive to you? What is it about this business that is unique? Maybe it's the IP, maybe it's the customers. What does this company bring to you, this target company, and how can you purchase that more cheaply than, or more on a more timely basis than perhaps by trying to build it yourself organically? Next, please. Culture. This is usually thought of as really the only sustainable competitive advantage that is under total control by the owner. So your culture is important to you, and a culture match with the target company doesn't just offer assimilation benefits, it also ensures that you don't mess up your foundational company culture by virtue of taking on another culture that is too different. Next, please. There are a number of financial metrics to examine, but key financial considerations to look at are revenue and cash flow. Assurance of revenue and the corresponding timing of it must match up well with how your company currently operates, and the amounts and timing of cash to the books is also essential to understand. Next, please. Just like sort of when you're buying a house, you want to know why the current owner is leaving. So very similarly, it's important to understand why the target company is available. So there are lots of different reasons. There are personal reasons, there are business reasons sometimes. Owner health or age or a change in family circumstances or some of the personal reasons. Business reasons might be contract loss or impending contract expiration, legal issues, or just a lack of sufficient profitability. But in any event, it's important to understand sort of, what those reasons are, having that background, and also knowing the timing of the target's exit plans. That's essential for you to get a positive transaction outcome, and also one that is, on the best financial terms for you as possible. Next, please. A final area here in this section is on the actual merging of two different companies. So creating a transition plan really as early as the letter of intent stage will sort of help you understand all that needs to be done and how long it will take. In fact, writing this out may help you when actually thinking about valuation of the target, certainly future cash outlays, key new hires that you may want to make, or replacements of people, and any other important transition elements. Next, please. So, does it seem easy? Well, not quite so fast. Next slide, please. So if it's so easy, why do 70% of M&A deals end up in trouble? I mean, either falling apart at the deal stage or ending up with a dissatisfied transaction partner set at the end of the transaction. Next, please. The culprit is really a lack of planning. Next, please. Transaction planning is what it's really all about, and it just requires upfront work. Rushing a deal is like eating undercooked rice at the meal. It ruins it. So you want to think about, a lot of this stuff in advance and making sure you are deal ready. You want to think about who's on your deal team. There's a lot to do internally on your part, just including financial planning, operational planning. There's a lot to do just with cash planning, plus a myriad of external considerations, all related to the deal. And all the while you're trying to do this, you're also trying to continue to run the base business. So it's important to have good advisors on your team. Next, please. You also need to be completely clear on what you hope to achieve with a transaction. This means understanding, what you are going to use or perhaps discard of the new capabilities that you might acquire. So, financially, your return on investment and its associated timing need to be well modeled and understood. Again, all in advance. Next, please. Other than the deal team and the plan that we've talked about, you also need a plan for capital and deal funding. You need to evaluate the trade-offs of an asset purchase only, perhaps, or maybe if you're acquiring assets, you might intend to sell off or write off some of those assets post-acquisition. Due diligence, you all have probably heard that term used before, and it's very important. It's one of the most important parts of the deal. When you're doing due diligence, you will discover things about the target company that the owner may have failed to mention, that maybe the owner forgot, or maybe that the owner never even knew. You'll uncover an awful lot about it. And that's important. Just expect it to take longer than you think. It is not a 2-week process. It requires a review of documents, multiple discussions, and you really get from that a much clearer picture of what the company looks like. So again, just expect that to take much longer than you plan. You're going to want to confirm really all the capabilities and sort of plan around the new challenges, potential blind spot avoidance. You want to finalize the post-transaction integration activities. Again, that ensures sort of a smooth segue into operations of a combined company. Next, please. You also want to link your goals and strategies together. So again, I know I'm beating a dead horse here. Start planning early. We can pretty much guarantee that this will take longer than you think it should take and will take. Pay attention to the trends. Know your market niche and its fundamentals. Also know the target's market niche and their fundamentals. Good projections that are sort of well thought and rationalized are worth way more than just sort of the historical numbers. Record keeping is another area that often gets overlooked. And we want to think about that. Risk gets elevated if you don't have sort of the good accounting record keeping that is essential. Taxes and estate matters. We recommend that you include either a wealth advisor or a tax professional in your deal team. That's important. That can help you just from a structure standpoint with getting the most advantageous treatment for your business and for you. Next, please. From a process standpoint, again, this is just sort of shows the path and steps. First step is to really clarify your own strategy, as we've talked about. Know what it is that what you're trying to do and what the ideal timing of your strategy should be for an acquisition, and the size. That sort of gets into the second step of building that target profile. Make it clear what it is that you are looking for. The third step really on identifying and selecting targets involves casting a very wide net with the goal of seeing really the largest number of candidates that meet your profile, and then sort of bringing those down into a smaller group that you can focus more time and attention on. Moving on to sort of outreach and evaluation. I mean, you're going to end up being surprised probably at what firms become viable targets. It may be firms that you wouldn't expect to see in there. So you know, it's that's why having again this very broad-based approach to evaluating and reaching companies is important. Then you're going to want to do a thorough comparative analysis of, you know, what do these companies look like? How do I identify really the best target for me? You'll have a chance to sort of fully review all of the aspects of the target company to your satisfaction before you know, finalizing the deal negotiations, doing due diligence. Sometimes step 5 and step 6 are a bit combined, but all of those are in advance of actually closing the deal. So you may end up with a little bit of a loop between steps 5 and 6 a little bit as you again do due diligence and finalize it. Next, please. As we finish up, let us leave you with you know, some of these key takeaways. You can turbocharge business growth with acquisitions, but you need a team and the right team really in order to do it successfully. To be deal ready really requires work, and again, more work than meets the eye initially. So it will probably take longer than you suspect. As your transaction plan gets closer, you want to, you know, plan on and think about how you're going to reach out to your employees as well as others, showing them really the benefits of this new combined organization and how it's all going to work together. And remember the synergies, you know, not only just the business synergies, but the cultural synergies that we talked about as well. Next, please. And lastly, you know, finding an experienced M&A advisor will help make sure that you don't end up in that 70% that we mentioned earlier. Here are some of the services that SpeedShift Ventures provides. I mean, we can help set up a strategic plan. We can evaluate if you are deal ready for a transaction, really on the buy side or the sell side. We can source buyers and sellers. Good deal books are important, including teaser documents, other, you know, confidential this company descriptors. All of those help sort of avoid a wrong turn and getting to where you want to go. We can guide with management meetings. This is sort of not our first rodeo. It may be, you know, oftentimes, you know, the business owner buys or sells a company once. As you know, between Sarah and I, we've got hundreds of deals of experience to look back upon. Professional deal execution really minimizes transaction failure. So, you know, SpeedShift is a licensed investment banking firm. Your transaction you need to think about is really not that of a local gas station that can be handled by the corner business broker. And lots of times the big Wall Street, in fact, most of the time, the big Wall Street firms don't handle smaller transactions. But for us, this is our sweet spot. We're happy, of course, to talk with you at any time, provide you some advice and help out where possible. Next, please. So this is sort of the end of our remarks. Sarah, happy to turn this back to you or open this up for questions as you wish.
Yeah, we're happy to field any questions now, but we understand that there's some questions may be very specific to particular circumstances that you may be going through or looking at. Jeff and I are happy to take those and schedule a separate call with you to go over those in detail. So with that, Scott?
Thanks, Sarah and Jeff. We appreciate it. One general question that we always get and is very worth answering is we have recorded the webinar, and everyone who's listening will have access to it in the future, as well as being able to get access to the slides. I will again emphasize that we'll leave the slide up with Sarah and Jeff's contact information while we answer a couple of questions that have come in, so that again you can reach out individually or more privately if you have individual or specific questions for either or both of them. One of the questions which I suspect you answered came through about halfway through the presentation, and it just asked to go into more specifics about the difference between organic and inorganic growth. If you could just define that. I suspect you may have hit it in the second half of the discussion, but just in case, if you could go back through that, that would be great.
Sure, I can start, Jeff, and you'd like to add. So what organic growth, basically what we're referring to is the elements and the fundamentals of your business that you have today, the growth engine that you have inside of your company, whether it's business development initiatives, you have capture, bid and proposal, all of those components inside of your company, including talent, that helps you put a growth plan in place. And so whether it's you're inside of a particular customer, you have a particular contract, and you continue to grow that based on the capabilities of the company that you have, internal to your company and the capabilities that you have. Inorganic means outside of your firm. Now, basically trying to identify opportunities, whether it's a company, whether it's a contract, whether it's talent from a company, components of a company that you then acquire and add to your mix of company. It's outside of your firm, inorganic in that way, and use it as a mechanism to continue to grow your firm. Jeff, would you like to add to that?
No, that really covers it. I mean, you think of inorganic as, as acquiring a totally separate company, adding to your revenue line. That's the easiest way to do it, versus organically, just sort of building it up from your daily activities and your business as usual approach.
Okay, great. We've got two more similarly or nearly related. One has to do with, would you just go back and review maybe the top couple of barriers that you see in most cases to companies to executing a successful strategy? And I suspect you may have a couple of answers to that, depending perhaps on the age and the size of the company. So, I know that that may be a little more complex than it sounds. So.
Sure. Jeff, I don't know if you want to take that or what.
Well, I was going to say, I hope I hit hard enough on it in the second part of the presentation, but the planning for this is really so critical. I mean, that's where it falls down. This is not something that you just sort of fall into one day and say, oh, I hear such and such a company may be available, I think I'll go buy them. That really doesn't work. There are so many elements of this that need to be thought through in order to get it done correctly. So I would say just advanced planning is the most critical. Sarah?
Yeah, sure. And one of the components with, you might not think of it as a logical sort of a thing necessarily, is that in your strategic plan, if you have one and have gone through the exercise, you are contemplating how you're going to grow your business. You've identified hopefully pockets where what your key strength is. But you also, in your plan, trying to figure out what ultimately where you'd like to grow to, you have figured out the gaps. You can use those gaps to then basically identify opportunities in the marketplace and not just be, I went out doing networking, I heard so-and-so company is willing to sell or what have you. You could actually have an active approach about it and know what exactly you want to do with those opportunities. If in fact you actually come and find out, yes, that a company with such and such contract is actually up for sale, or the business owner is open to discussions about possibly selling or getting rid of a particular contract or entire company. So the planning part that we're talking about, it provides you with a framework to figure out what is going to be an opportunity and what is not, and really bring focus into that sort of activity. And that's where we see it fall apart, where that planning wasn't in place. So didn't put sort of infrastructure around it internally, and it just was sort of somebody, knocked on the door and figured out, oh, hey, I wanna sell this particular contract or what have you, but then it fell apart in the integration. It may have gone forward a little bit, but then it becomes part of the statistics that Jeff was talking about, because during the integration and everything else, because the planning wasn't there, it fell apart.
Great, wonderful. Sarah, Jeff, this has been an incredibly informative hour. We certainly appreciate you taking the time and look forward to doing this again in the future. The MVSBC appreciates our friends and partners out there who help our members to be great business people and support them in their endeavors, and you certainly contribute to that. We sure appreciate it, and thank you for your time today.
Thank you,
Thank
Scott.
you. Thank you for
Thanks.
including us. Thank you.
We'll see you next time, okay? Thank you so
All right.
much.
Take care.
Bye now.
Thank you. Take care. Bye-bye.
Bye-bye.